Hello, everyone, and welcome to Currency Exchange, a NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I head the G10 FX strategy team for NatWest here in the U.S., and today I'm happy to be joined by Paul Robson, who heads our G10 FX strategy team over in London, to discuss all things major currencies this week. Paul, thanks very much for joining.
Well, as always, thanks for the invitation. Certainly looking forward to running through everything that's been happening. It seems to be every day something new coming out. So thanks again for the invitation.
Yeah, that is absolutely the case. It feels like every day the themes are changing, certainly coming from the U.S. here, and I'm sure we'll touch on that in a little bit. But I do want to start with Eurodollar, which I feel like has been the big focus in FX markets following a week of significant upside in the common currency. I did want to talk about, ask you about some of the drivers of that, because of course we've seen monetary policy, fiscal policy, both contributing as well, but we're also having to adjust on the fly to changes in international policy that's coming out of both Eastern Europe, the European Union themselves, and also here in the US. So how are you thinking about these factors as we're trying to figure out the next steps here for Eurodollar?
Well, as you say, I think Eurodollar has been front and center of global currency markets over the last week. I think it just fits so neatly into the things that are driving global asset markets, most obviously out of the US. And I think that what's been happening is impacting both sides of that particular cross. I think for the euro, it's more about US foreign policy rather than, say, economic policy or international politics. I think we'll go into that in a little bit more detail. For the US, it feels more like the international trade policy that is the key driver, moving interest rate expectations. Foreign policy is also moving interest rate expectations in Europe as well. And the way I try to think of it, keep it quite simple. And I think we got to a point where we had peak pessimism around the euro area growth outlook. That's not to say it's going to change particularly quickly. I think these things are glacial in nature, but I think a lot of people were very negative around the multi-year outlook for the euro area, and I think that people are having to revisit that. At the same time, I think markets got to a point of almost peak optimism around the US economy, and I think people are just sort of revisiting that idea about the sort of impact of various economic and foreign trade policies out of the United States, and I think that's translating into what's been quite a steep rally in Eurodollar. On the euro side, it's about fiscal policy. It's about defence architecture in Europe with a shift in foreign policy from the US. But I think it goes beyond that, because we are going to get quite a significant multi-year, multi-decade, I guess, increase in defence spending. But we are also going to get increased infrastructure spending and reforms, I think, ultimately in the euro area. The one thing that the euro area likes, in a way, is a crisis, and they always come out stronger for that. If you think about the energy crisis in Europe, European debt crisis, it all led to changes as well. But as I say, defence spending will take time. Infrastructure spending, just by their very nature, it takes time. But I think growth expectations will ultimately be revised higher. Immediate focus is Germany, trying to get a deal in terms of fiscal policy through before the new government arrives later this month. For the drivers of Eurodollar too, I think it's really interesting to see that a lot of the recovery simply reflects a shift in interest rate expectations. And I think the challenge will come if markets challenge the idea that maybe the Fed doesn't cut rates 3 times this year as currently priced. For me personally, on the euro side, I'm particularly watching to see if Eurodollar gains run ahead of interest rate shifts, because then that might just hint at maybe the dollar's global reserve currency status. There is no alternative to the dollar as a traditional number one global reserve currency. But as we've sort of talked about, Brian, over the last sort of, I don't know, a decade, there are other currencies that are useful in terms of reserve management diversification. And so we'll be watching the sort of COFA data, I think, won't we, over weeks and months ahead to see if something more important is happening.
And I think that's a good way to frame this move here is that, there's a sense I think in the market that this move is just a response to short-term drivers, whether that be changes in fiscal policy expectations here in the US versus what's happening in Europe, and also relative short-term interest rates as the markets are pricing in more greater risk of Fed cuts, right? But I think that's an important one that you bring up, which is that there's not just a short-term story here. There may also be a longer-term story here about the dollar's place. You mentioned the reserve currency status, an important one to point out because, if there's a long-term slow burn story where US dollar holdings as a percentage of total reserve assets has fallen from about 70% and as of around 2000 to closer to 60% now. So it's not like that story hasn't been happening. I think the question markets will be asking themselves is this something that has more scope to continue as the US sort of changes its approach to the international financial system? So super interesting. The long-term consequences versus short-term seem to be really important to watch here. I do want to ask you, as we look across Europe and I look at some of the best performers in G10FX this year, it's not just the euro that has rallied, it's also some of the currencies that are linked to European growth, with Sweden in particular, the stocky really outperforming here. Do you think that's just a reflection of what's going on in Europe? Is that just a reflection of a better growth outlook in Europe? What are some of the drivers there that you're watching?
Yeah, I think to some extent it is just, I think we describe it as the sort of beta on European growth. I think that that's been part of the story. But it's interesting, isn't it? Once euro dollar starts to move, it's the same with Asian currencies. Once dollar CNH starts to move, all the other regional currencies all start to move to varying degrees. And it really depends on the sensitivity to what's happening in the underlying drivers of the euro, as you quite rightly point out. I mean, the impact on the Swedish krona has been really, really stark because it has been one of the underperformers over the last 2 or 3 years. It's been persistently weak. So this is a real sea change in sentiment. And I think to some extent it reflects what's happening in the euro area. But I also think it reflects a scramble, I think, for pension funds in Sweden to hedge overseas assets of domestic investors. One of the themes in Sweden over that period where the currency has been weak is pension money savings flowing out of Sweden into what was perceived to be faster growing, higher yielding currencies and economies. And the US is obviously one of those, something that you've talked about a lot in recent years, US exceptionism, and that money would have flown. And I think to some extent, because the Swedish krona had been persistently weak, perhaps people hadn't chosen to hedge the exposure because they just thought that they'd get some currency gain on top of their equity gain. And that was pretty profitable. So maybe what we're seeing is a race to lock in some of those gains if markets were a little bit worried that, or those international investors are worried that the landscape is changing under Donald Trump. A second point, I think, is just underlying growth in Sweden. It was going to be relatively good. It's proving to be relatively good. It's the sensitivity on lower interest rates by the Riksbank. It was one of the hardest hit economies when interest rates went up more immediately. In the UK, it's been a little bit of a slower burn. In Sweden, because of a lack of sort of fixed term mortgages, it was quite impactful. So as interest rates have come down, inflation has come down, growth has responded. And I think international investors are looking at that too. And the third point, I think, again, it's this point about markets are shifting a little bit from monetary policy to fiscal policy within Europe. Well, one of the economies or countries that has the best fiscal position is Sweden. So if the euro area, European Union, euro, the whole of Europe needs to increase defence spending, well, Sweden can do that much more easily before hitting sort of debt limits than nearly any other country across Europe, bar Norway. So I think you take those three factors, and we thought that the Swedish krona would do relatively well. It has done well, and I think it continues to perform well.
Yeah, it's super interesting. Just taking Sweden as as sort of a case study almost, where so far in 2025, you've seen the outperformers in G10 FX space have largely been these lower yielding currencies. You look at the yen as well, with similar questions about are a weakening in the U.S. equity market and maybe a stronger yen in combination leading to some shifts in the way that local investors are thinking about unhedged positions in external assets, for example. It just feels like, to your point, Paul, it feels like the specifics of monetary policy and carry as the sort of be all end all driver of FX markets. It feels like, that story is coming under a little bit of pressure here as the market just, focuses a lot more on growth and the shifts in growth, the shifts in fiscal policy on both sides of the Atlantic here, and how that could impact FX valuations. I did want to ask you as well about sterling. It certainly feels like the UK is on the back burner right now relative to all the potential changes happening in the EU and the US. How are you thinking about sterling here as we consider how you talk about being stuck between two in two worlds here? How are you thinking about the UK as we're considering all these changes with the US and EU policies?
Yeah, it does feel like the UK's been sidelined. It's been quite a nice change, actually, watching markets moves elsewhere outside of the UK in terms of currency market. Sterling's been moving around. It's been participating in the dollar weakness that we've seen, but it's been underperforming other European currencies because I think it's that adjustment in growth expectations in Europe, less so in the United Kingdom. I think in terms of tariffs, for the time being, it's been sidelined. The UK doesn't have this big trade surplus in goods with the US that the rest of the euro area has, so it's not necessarily the focus. Yes, we've had steel and aluminium tariffs on all countries, but that particular part of the UK is relatively small given the size of the economy. That might change, I guess, if we get reciprocal tariffs come April. I'll certainly be looking forward to listening to what you have to say. It does feel like that's going to come down. That will be more impactful because it hits sort of everyone. But international trading goods for the UK is less important. So I think on the margin, that's a small positive, but I wouldn't overplay it. The second point, the sort of mood music around the UK's relationship with the European Union. I'm not saying that anything changes quickly or significantly, but it's not a negative, the shift in focus of European policy to defence architecture. And there'll be some collaboration, I'm sure, in terms of industrial policy. So at the margin, again, a small positive, but not a game changer. In terms of the main driver, I think carry, the UK Bank of England stays a cautious central bank. Inflation's sticky. They're a bit worried that the little spike in inflation becomes a little bit more persistent. They'll just wait till they're doubly sure. And that tends to be supportive of the currency. But I think when we think about the first question that you mentioned about the sort of fiscal policy change in US international and foreign policy, and this gear shift in fiscal policy across Europe at a time when the UK's fiscal position is already relatively constrained. Gilt yields are once again moving higher. And if markets just start to worry a little bit again about debt sustainability in the UK, I think sterling would come under pressure. So I think that's your number one risk to watch for the UK and sterling. For the time being, I think it's okay, but I wouldn't want to see long end yields rise significantly more from here. I think that sort of covers Europe in quite a lot of detail, but just circling back to what's been causing all the underlying moves in markets, and that's certainly US politics, whether it's tariff policy or just government spending, that's clearly also in focus. I was just wondering how you thought about the latest news out of Washington and how you see it ultimately. What does it mean for the dollar?
Yeah, thanks, Paul. I mean, I think if we can just sort of distill down what's happening in DC in as short of terms as possible for what it means for the dollar, I think markets are trading the dollar off of their assessment of the risk of recession or hard landing risk. And anything that's increasing hard landing risk in the US is leading to weaker dollar. And anything taking away that hard landing risk, maybe pushing back against that, is maybe supportive of the dollar here. And I think the way the markets are trying to assess Trump policies is through this lens of, are they increasing or decreasing the risk of hard landing? Are they accelerating the push away from US dollar or US economic exceptionalism? Or are they pulling back from that? And I think that's one of the reasons why dollar sensitivity to tariff policy appears to be less so than it was during Trump 1.0, where it feels like the assumption we made going into the Trump presidency was that the tariff push would be positive for the dollar just because of how it could be potentially much more damaging for external economies than it is for US economy. But I think it's clear that markets are rethinking that here, given where we are in the economic cycle and given where inflation is, that we continue to see, albeit with some better numbers this week on inflation. Markets are looking at tariff-related potential upside risks to inflation and how that might feed through to consumers. Now, the soft data we have seen on consumer confidence has shown some, at least early signs, that consumers are a bit worried about the direction of travel and the speed of the change in fiscal policy, whether it be from tariffs, which I think is certainly a big concern for businesses, but also on federal hiring as well. And I think you've seen that with concerns throughout, both consumers and businesses about the changes and the speed of the changes in terms of federal employment and how that might impact the overall labor market, the confidence, consumer confidence in the labor market. Because one of the things that we have seen throughout this recovery, this resilience of the U.S. labor market, has been demand from private side businesses has been good, although falling demand for labor, I should say. And then that you have seen easing back in terms of labor market pressures because of some slowdown, but not a material slowdown in labor demand versus some improvement in terms of labor from the supply side, with immigration being a big part of that story. But I think the market is viewing the U.S. economy as increasingly late cycle, and looking for what are the potential risks that could push the economy more clearly into a slowdown. And I think they're assessing these policies through that lens. And so I think it's clear that the dollar is maybe less sensitive in terms of upside risk, specifically from tariff developments. Now, those tariff policies are going to be changing. They change effectively every day. We're all looking ahead to April 2nd as a big date that Trump has promised lots of potential implementation. Now, it's not to say that the dollar couldn't strengthen through that, but I do think that markets are going to continue to trade tariff risk as far as the dollar is concerned with maybe a more nuanced approach rather than simply more tariffs means stronger dollar in all cases. And I think we've seen that so far. The other thing, as I mentioned, we're all watching is changes in federal hiring and what that means for the labor market. Now, we're only 50 days or so into Trump's presidency, and we don't have a lot of hard data yet on the economy and on the labor market. But what we do have so far is a non-farm payroll report for the month of February we got earlier this month that didn't fall, I think, on the government side as much as some had feared. And we also see initial claims for unemployment insurance, maybe an early warning sign for potential increase in layoffs, have also been relatively stable. And so the hard data side, you haven't really seen. I don't think you've really seen clear moves in the weaker direction, but it's clear that on the soft data side, and certainly from relative equity performance side, I think you have certainly seen those expectations move up in markets. And so, the policies on government is, the government policies are going to change every day. Tariffs, risks are coming on and off effectively every single day. Government funding debate is currently going on now. We'll see how that resolves itself on Friday, when we could potentially see a government shutdown. And there's, of course, broader questions about the direction of travel for federal employment and what that means for the broader economy, spillovers into the broader economy. But maybe to distill that back, I think the markets are trading all of this, and our approach to the dollar should be: how are the hard data and what's happening with the with fiscal policy, influencing hard landing risk, or sort of are they pushing that forward? If it is, I think that's maybe weakening the dollar through this lens through this channel of lower dollar exceptionalism, or vice versa.
Yeah, I guess in the end, the final arbiter will be the data, and it's the hard data. You mentioned the labour market data is always the focus, and it's taken on even more importance. The other side of it, and especially for the the Fed will be on inflation, the sort of pass through from tariffs, if there is any pass through into inflation, but also the underlying economy as well, the sort of persistence of inflation. We've had a few sort of softer inflation numbers this week. We obviously got the FOMC next week. Just wondering how you are seeing those inflation numbers and around the Fed outlook, because that's clearly still important for the dollar.
Yeah, absolutely. And I mean, you mentioned it at the offset, Paul, that the dollar and Eurodollar especially are still tracing pretty closely with the evolution of front end interest rates, and so that puts pretty clear into focus, if the markets are over versus underestimating the likelihood of Fed easing and how, inflation and the data play into that, that obviously still has important ramifications for Eurodollar and for the dollar broadly, even if we think that fiscal policy and changes in growth expectations are taking on a larger role, that the Fed is no longer really the only game in town, that carry is no longer the only game in town. We did get some softer inflation numbers this week, both in terms of the top line CPI numbers, headline and core, both a bit softer than expected in terms of the increase. Similar with the PPI numbers that we got, the producer price index, also softer than expected on the top line numbers. Now, the Federal Reserve's main measure of inflation is the PCE deflator, specifically the core deflator. And one of the things that the markets were watching is, how much of the weakness in these numbers translates into that measure? If you remember at this time last month, the core CPI was extremely strong. It was very, very high. But most of that strength did not translate into the core PCE deflator, and that allowed the market to take a bit of solace that some of that strength was not going to come through in the Fed's preferred measure. This time around, it's a bit of the inverse, where most of the weakness, especially in the CPI, actually will not feed into the core PCE deflator. So it looks like the core PCE deflator is probably going to still come in relatively firm compared to where we were on the CPI. So you sort of take the market's reaction to the very strong number last month, and the market had some solace in the fact that most of that strength wouldn't feed through. Now you have weakness in the CPI, which is welcome, but some of that weakness is not going to feed through because of the specific categories and how they filter back into the core PCE deflator. And so you have this situation where we have U.S. inflation numbers that have come in a bit softer, although unlikely to feed into the core PCE deflator as clearly as they did into the CPI and the PPI. Now, I think in sort of, let's call it normal times, if you can call any times normal times, I think the market would look at weak CPI, weaker PPI, and would see a sharply weaker dollar as a reflection of the evolution of Fed pricing. This week we saw, again, not to overuse the term, but maybe a more nuanced reaction here, where the dollar really didn't accelerate to the downside. If anything, it's actually a touch stronger this week as we've seen a bit of consolidation. And I think this relates back to the point I made earlier, which is that markets, I think, are internalizing all data and everything going on from the fiscal side as how does it feed into hard landing risks in the U.S. Because regardless of what you think inflation is going to do because of fiscal policy, the baseline for where we are now is really important into growth expectations. And all things equal, inflation pressure coming down is really good news for growth in the U.S. because it allows maybe the Fed a bit more flexibility, and it could potentially alleviate some concerns among consumers about where inflation will be and how that will feed through into growth. And so I think part of the reason why we've seen the dollar consolidate here is because the markets are looking at inflation being a bit softer as maybe reducing hard landing risk a bit here. Now, of course, this is only just 1 month of data, and we still have plenty of potential tariff risks and other risks on the horizon. We think for the Fed, they're going to have a very difficult time returning to easing simply because of those risks. As we look ahead to the Fed next week, though, the Fed seems very, very comfortably on hold. We don't think the guidance and the dot plot needs to change all that much to reflect the Fed's current stance. What the Fed's been telling us is that they are in no hurry to ease. They're in no hurry to change their policy stance. They don't seem to be in a particular hurry to change their guidance. And I think Trump and fiscal risks only add to that sense of patience here, that they, like us, do not have a lot of clarity on what the ultimate policies will be, let alone what their growth impacts will be. And I think they will be looking at the hard data as well. And most of the hard data they have seen so far haven't incorporated these downside potential risks, or they're proving to be somewhat resilient in the face of these potential downside risks. And so we don't think the Fed next week really has to change its message all that much. And so for the dollar, I think as usual, the markets will be watching the dot plot. Now with the median dot for 2025 from back in December showed 2 interest rate cuts by the Fed as kind of the baseline. Governor Waller earlier this month basically said he still thinks that that is a reasonable expectation in terms of what Fed policy could ultimately be. Right now, the markets are pricing a little bit more than that. Our expectation is that the Fed will end up going less than that as it stands now. So maybe you see the market respond to, if the dot plot doesn't change all that much, maybe that's taken as a somewhat hawkish signal relative to where the markets are currently priced. But we think that the core message from the Fed here is going to be, we don't have enough information to make a major change. We don't think that the data are telling us that we need to be making a major change just yet. And we feel very comfortable in wait and see mode. And I think that's how the Fed will be approaching it next week. So with that, I think we've covered a ton of ground, Paul. Thanks very much for joining. And to our listeners, thanks so much for listening. If you enjoyed this podcast, please consider giving it a like and also subscribing to our channel so you get our latest content the moment it's released. Thank you very much.